Welcome to the Deep Dive. Today we're tackling a really vital piece of legislation for anyone dealing with employment or finance in South Africa. It's the Unemployment Insurance Contributions Act, Act 4 of 2002. You'll often hear it called the UICA, our mission. To make sense of it for you.
It really is crucial. You know, the UICA, it's like the financial engine room for the whole unemployment insurance system. And our sources show, well, it might have started back in 2002, assented March 27th, started April 1st, but it's definitely not stuck in the past.
Right, it's not just some old document gathering dust.
Not at all. It's constantly being tweaked. We see updates as recent as December 2024. It gets amended all the time, often indirectly through big finance laws like the Tax Administration Act or, various taxation laws amendment acts.
So changes happen even if the amendment title doesn't scream unemployment.
Exactly. And that immediately tells you something important. Managing Social Security contributions is now deeply, deeply tied into your tax compliance. You can't separate them anymore. That integration is key. Okay, so let's step back a bit. What's the fundamental reason for the UICA? The main goal. Well, Section 2 spells it out pretty clearly. It's there for one main reason: the imposition and collection of contributions.
And those contributions are specifically for the benefit of the Unemployment Insurance Fund, the UIF. And naturally, the Act also sets up the procedures to make that happen.
So it's the law that makes sure money actually gets into the UIF pot. Precisely. It's the mandatory funding pipeline for that social safety net. Okay, makes sense. With that purpose clear, the big question for employers and employees too is, does this Act even apply to me? Let's get into part one, figuring out who's in and who's out.
This is ground zero for compliance, isn't it?
Absolutely. Section 1, the definition section, is where it all starts. The Act defines an employee in a fairly standard way, basically, any natural person getting paid remuneration for work they do. But, and this is a huge but, it specifically excludes independent contractors.
Right. So if you hire a freelancer or a true contractor, the UICA doesn't apply to that relationship.
Correct. No UICA liability there. The Act really focuses on that genuine employee bond.
Which makes getting that employee versus independent contractor classification right even more critical then. Get it wrong.
And you could be looking at a nasty surprise down the line. Think potential liability for years of unpaid contributions. It's a major risk.
Okay. So assuming you've established it as an employee relationship, the next step is calculating the contribution based on their remuneration.
Yes, and while remuneration usually means almost everything an employee gets, the UICA carves out some specific things. It narrows the definition for contribution purposes.
What are the main things excluded from that calculation base?
Well, you have to leave out any amounts paid as a pension or a superannuation allowance or a retiring allowance. And critically important, you also exclude commission.
Commission is excluded. That seems significant for sales staff.
It is. And it's an area the government keeps refining. Like our sources mention Act 44 of 2024, which kicked in recently in September 2024. It shows they're constantly adjusting these definitions, probably to ensure the contribution base is fair and consistently applied.
So it's a definition you need to keep checking, basically. It's not static.
Definitely not. Constant vigilance required there.
Now, you mentioned specific worker types earlier. Let's look at domestic workers and farm workers. How does the Act handle them?
This is interesting because it shows how detailed the law can get. The UICA defines a domestic worker really broadly. It's not just, housekeepers. It includes gardeners, drivers employed by the household, even someone you hire to care for a relative in your home.
So that home-based carer example, they're definitely covered by the UICA definition of domestic worker.
Yes, clearly included. But here's the twist, the specific detail that often trips people up. The definition of domestic worker explicitly says it excludes a farm worker.
Excludes a farm worker.
Yeah.
So even though they might live on the property, similar maybe to some domestic staff, they're treated differently for UICA.
Exactly. Farm workers fall under different rules for UICA compliance, even if they're covered by other basic labor laws. It's a crucial regulatory split.
Okay, that clarifies who's generally in. But then Section 4 lays out some clear exemptions. People or roles completely outside the UICA scope. Who gets a pass?
Right. The most common one, probably affecting casual labor, is any employee who works for less than 24 hours in a month.
Less than 24 hours a month. Okay, so very minimal intermittent work is just outside the system.
Correct. It avoids administrative burden for really marginal employment.
And then there are the exclusions related to government and political roles. Why exempt them?
Yeah, this is largely a policy decision reflected in the Act. It excludes the president, the deputy president, ministers, deputy ministers, members of the National Assembly, members of provincial legislatures. These roles often have their own distinct benefit schemes or contracts outside the standard public service framework.
So it's because their terms are set up differently?
Often, yes. The Act also excludes certain other public servants, those defined as officers or employees under the Public Service Act, plus members of municipal councils, traditional leaders. It draws a line.
So the UICA is mainly aimed at the private sector and then standard public sector jobs, but it carves out the top political tier and those under specific other public service rules.
That's a good summary. It sets a clear administrative boundary. All right, we know who's covered, who's not. Let's move to the core mechanism, the money. Part 2. Contributions. How much and who pays? Okay, the basic duty is in Section 5. It says every employer and every employee covered by the Act must contribute monthly to the fund. It's mandatory.
Non-negotiable. And that brings us to the famous 1% rule. How does that actually work?
That's Section 6. It's quite straightforward, really. The employee has to contribute 1% of their remuneration, and then the employer matches that. They contribute another 1% of that same employee's remuneration.
So for every employee, the total going into the fund is 2% of their remuneration, split equally between them and their employer?
Exactly, a flat 2% total.
But wait, that 1% doesn't apply to, say, someone earning millions a year on their entire salary, does it? There's a limit, a ceiling.
Correct. There is a cap. The Act says the 1% rate doesn't apply to the portion of remuneration that goes above an amount set by the Minister of Finance.
And why have that ceiling?
It's about balancing things. It keeps it an insurance system, not just a tax. High earners don't contribute endlessly into a fund from which their potential payout is capped anyway. It basically limits the insurable earnings. This is pretty standard in Social Security systems worldwide. It prevents the system from becoming overly skewed.
Makes sense. Now, the employer's role here is huge. They're not just paying their share. Section 7 makes them the collector for the employee's share, too.
They are. They effectively act as the collection agent for the state regarding the employee's 1%. They must deduct it monthly. But there are strong protections for the employee built in. The employer absolutely cannot deduct more than the 1% owed.
And they can't charge the employee a fee for doing this admin work.
No way. The Act explicitly forbids charging the employee for compliance costs.
And what about catching up on missed deductions? Is there a time limit?
Yes, and this is a critical protection. An employer cannot deduct arrear contributions money they forgot to deduct earlier from the employee after the end of the financial year when those contributions were supposed to be paid.
So if the employer messes up and doesn't deduct on time within the financial year,
they lose the right to recover that specific employee portion from the employee later. The employer has to cover it themselves. The window closes.
Wow, okay. That leads directly to the risk aspect. If an employer fails to deduct that employee's 1%, what happens?
Section 7, subsection 4 is blunt. The employer becomes liable not only for their own 1% share, but also for the 1% they failed to deduct from the employee. They can't just pass that missed deduction on later.
The buck stops with the employer.
It does. But the risk gets even more serious, especially for people running smaller companies. We're talking personal liability.
Personal liability, how's it work?
Section 7, 4A. This applies specifically to unlisted companies. If the company correctly deducts the employee's 1% from their pay, but then fails to actually pay it over to SARS or the UI commissioner, then the representative employer and every director and any controlling shareholder who is involved in managing the company's money can be held personally liable for that unpaid amount, plus interest and penalties.
Whoa. So the individuals in charge become personally responsible if the company pockets the UIF money deducted from staff.
Precisely. The law treats those deducted employee contributions as funds held in trust for the state, not as regular company cash. It pierces the corporate veil. It essentially brings the heavy enforcement tools of the Tax Administration Act down on the heads of the company leadership. It's a massive deterrent and a huge risk factor, particularly for directors of private companies. That really underscores how seriously the government takes these contributions.
Okay, let's shift gears to part 3. How is this all managed? Administration, enforcement, and where the money goes.
Right, and this loops back to that integration point we started with. Section 3 makes it clear. The South African Revenue Service, SARS, acting as the commissioner, handles the collection side for most employers. And critically, SARS applies the procedures and powers of the Tax Administration Act to do it.
But you said most employers. So not everyone pays via SARS. There's that dual system you mentioned.
Exactly. The general rule under Section 8 is that employers pay the contributions monthly to the commissioner, which is SARS. This usually covers employers who are already registered for payee under the Income Tax Act's fourth schedule, or those paying the skills development levy. They just use the existing SARS systems.
Okay, so who are the exceptions? Who pays elsewhere?
Section 9 covers this. Employers who aren't required to register under those specific tax schedules, or maybe don't pay the skills development levy, perhaps very small businesses or specific types of employers, they pay their contributions directly to the Unemployment Insurance Commissioner.
So there's a separate channel to catch those outside the main SARS net.
Yes. It ensures everyone complies. And there's even flexibility built in, like Section 8(1)(a), which lets registered microbusinesses line up their UICA payments with their income tax payment cycles under the sixth schedule. It helps streamline things for them.
Okay, two payment routes, but registration is mandatory for everyone, right? Section 10.
Yes, all employers liable for contributions must register, either with SARS or the UI Commissioner, depending on which route applies to them.
And what if payments are late? What are the consequences?
Well, they're pretty immediate and stack up. Section 12 says if you fail to pay on time, interest starts accruing on the outstanding amount right away.
Okay, interest. Is that it?
No, on top of the interest, Section 13 mandates a default penalty. The commissioner must impose a penalty of 10% of the unpaid contribution amount.
A mandatory 10% penalty. That's hefty. Can it ever be waived?
It can potentially be remitted, yeah, but that's subject to the rules and discretions outlined in the Tax Administration Act. It's not automatic.
Now, the enforcement side. This integration with tax law really comes into play with inspection powers, doesn't it? Labor inspectors get involved.
This is where it gets fascinating. Yes.
Yeah.
Either SARS or the UI Commissioner can ask a labor inspector, someone usually dealing with, basic conditions of employment, to help investigate UICA compliance. And Section 15 gives that labor inspector, listen to this, the exact same powers as a senior SARS official operating under Chapter 5 of the Tax Administration Act.
The same powers as a senior tax investigator.
Mm-hmm.
What does that mean in practice?
It means things like powers of inspection, search and seizure, demanding documents, conducting inquiries. All the heavy-duty tools usually associate with tax enforcement can be wielded by a labor inspector specifically for UICA purposes.
Wow, that really merges labor law oversight with tax enforcement muscle. It significantly raises the stakes for noncompliance.
It does. It's the state leveraging its most powerful collection and investigation agency, SARS, to backstop Social Security contributions. It's efficient.
Okay. On the flip side, what if an employer accidentally pays too much? Can they get it back?
Yes, but there's a time limit if the payment went directly to the UI Commissioner. Section 9(4) says you have to apply for a refund of overpaid contributions, interest, or penalties within 5 years from the date you made that payment.
5 years. So you can't wait indefinitely. The clock is ticking from the payment date.
Right.
Finally, let's trace the money. SARS, or the UI Commissioner, collects it, but it needs to end up in the Unemployment Insurance Fund. How does that transfer work?
It's laid out in Section 11. When SARS collects the money, it first goes into the National Revenue Fund, the government's main bank account, essentially. But the law says that amount is then immediately considered a direct charge against the National Revenue Fund. It's automatically earmarked and transferred across to the credit of the Unemployment Insurance Fund.
So it's ring-fenced. It doesn't just get lost in general government revenue.
Exactly. It's a dedicated flow, ensuring the contributions fulfill their purpose.
And who pays for SARS' trouble in acting as this massive collection agency? Does that come out of the UIF?
Yes, the fund covers the collection costs. Section 16 says the Director General of Labor has to pay SARS's collection costs out of the UI fund each month. But there's a cap on that. The costs can't exceed 1.5% of the total contributions collected. It ensures the collection is paid for, but doesn't excessively drain the funds meant for beneficiaries.
Okay, so this deep dive really shows the USAA 2002 isn't just about a simple 1% deduction. It's a really complex piece of financial law. It sets up the whole funding system for the UIF, relies heavily on tax administration for enforcement, defines key terms carefully, and crucially, imposes serious liability, even personal liability, for non-compliance.
That sums it up well. It's the financial heart of the system operating through this integrated tax and labor framework. And just to leave you with something to think about, remember this act is still evolving. Our sources point to several uncommenced amendments. These are changes already written into law, but not yet switched on, so to speak. For example, there's potential for Section 12, the part about interest on late payments, to be fully repealed eventually.
Repealing the interest section, that would be a big shift.
It would. And another pending change mentioned is redefining contribution itself to explicitly include administrative penalties imposed under the Act.
Wait, so a penalty could legally become part of the contribution owed?
That seems to be the implication. If that happens, it fundamentally changes the calculation and the nature of what an employer owes. It makes penalties potentially part of the core debt, not just an add-on. So you need to consider how these changes, currently waiting in the wings, could further tighten the screws on compliance and shift financial burdens for employers in the near future.
It highlights that you can never just read legislation once and assume you know it, especially financial law.
Absolutely. The USEA 2002 demands ongoing attention.
A really crucial point. Well, that's all we have time for on this deep dive. We hope this breakdown of the UICA has given you a much clearer picture of its structure, its impact, and its serious implications.
Until next time.